it's your mortgage expert, Brian McCauley here. So in today's video, I'm gonna teach you all about an escrow account. What is it? How does it work? Why is it required? And I'm gonna teach you a secret to try to avoid that escrow account if you can. Stick around in this video. I'm gonna teach you everything you need to know. Let's get into it. So listen, buying a house is a big deal. Getting a mortgage is an even bigger deal. And sometimes when you've never got a mortgage before, or maybe it's your second or third time, as a home buyer or potential home buyer out there, you get confused around what all these mortgage lingos and acronyms and nicknames and all these things mean. So today I'm gonna talk about an escrow account. So what an escrow account is, it's a back-end term that really refers to the breakout of your mortgage payment in its entirety. So on mortgage payments, you have a couple different things to make the payment a complete and total payment. Number one, you have the principal and interest. So how much money are you borrowing? What are the terms? What is the interest rate? That would be the principal and the interest. The second thing you would have in there would be the homeowners insurance. Sometimes it's referred to on a piece of paper on the mortgage side as hazard insurance, but it's just a fancy word for homeowners insurance. That is the insurance you'll have on your house for coverage, just like you have insurance on your car, you have insurance on your house. So you have the principal and interest, you have the homeowner's insurance, and the third piece is the property taxes. So whatever obviously city you're buying in, whatever property you're buying, you're gonna go to the county record, look up the property address, it's gonna say the annual taxes are $12,000. So what lenders do is they take that annual tax certificate, whatever the total is, in this situation if it's $12,000, we'll divide it by 12 because there's 12 months in the year, and we'll use $1,000 as the property tax monthly payment, and that will add into the total of the entire payment. So you'd have the mortgage, principal and interest, you'd have the homeowner's insurance, and you have the property taxes. Now, some of the more mortgages have another caveat and another layer there, which is mortgage insurance, but for the exercise of this loan, I'm gonna keep that out. So three things: mortgage, which is principal and interest, homeowner's interest, property taxes. Now, the escrow account refers to the bottom two, the homeowner's insurance and the property taxes. So I always recommend trying to do a separate escrow account and not including them in the total payment. I'm gonna explain to you why. Some home loans, and I'll get into this at the end, mandate that you keep your taxes and insurance in the payment no matter what. Some home loans give you the option if you put a certain amount of money down. And some home loans say, hey, you can remove them if you want to. The simple takeaway is this: if you're not good with saving money, it's probably best that you keep your taxes and insurance in the payment in the total and just pay that to the mortgage company, and then let the mortgage company pay those bills at the end of the year. So what are those bills? One of the things that's required in the state of Texas when I have a mortgage is you have to get homeowners insurance. And the state of Texas requires that the consumer, the buyer, prepay a year's worth of homeowners insurance up front. So obviously 12 months of the insurance will be paid up front. When you close, whatever the property tax bills are, they take that and divide that by 12 like we discussed, and it makes out the total payment. So effectively, if you want to remove the escrow account, assuming that you can, you would have a mortgage only, and then obviously the homeowner's insurance bill and the property tax bill would be due in full. You have to be careful with this as a consumer, because the problem is people that are not good savers may get a $500,000 home, the mortgage may be $2,500, the homeowner's insurance may be $500, and the property taxes may be $750. If you remove the insurance and the taxes from the total payment and you say, hey Brian, it's okay, I'm responsible with money, I just want to pay the mortgage, I'll pay those insurance bills and I'll pay those tax bills at the end of the year in a lump sum, that's totally fine. But you're going to have a really small payment throughout the life of the loan and each and every year, and then those homeowners insurance bills and those property tax bills are going to come due in full. Sometimes $2,000 or $3,000 for the homeowner's insurance. Sometimes the property tax is going to be anywhere from $8,000 to $30,000, depending upon how big your house is. So again, I go back to my original statement, which is if you're good with savings, you can remove the taxes and the insurance from the payment and then just pay the annual bills on your own. If you're not, or you're in a loan that requires the mortgage, taxes, and the insurance to all be included at one, and you pay it directly to the lender will take the responsibility and the risk off of you, and they will pay those homeowners insurance bills and property tax bills at the end of the year as they are collecting monthly payments from you as the consumer. So why does this matter? Well, two things. One, if you elect to not have an escrow account, number one, it will take the taxes and the insurance out of the payment and you'll be responsible for it at the end of the year. The simple thought behind this is pay now or pay later. If you pay now, it'll be smaller increments over a period of time, but you won't have to pay the big bills later. If you don't pay now, it'll be the mortgage only. You won't pay anything towards those bills but the big bills will come out at the end of the year and you're required to pay them in full. Now, some people like this because they like to manage their own money. I don't have an escrow account on any of my properties. If my property taxes were $2,000 a month and my homeowner's insurance was $500 a month, effectively I'm giving a bank $2,500 a month to hold my money for me and then effectively pay my bills at the end of the year. And so the way that I look at it is I'm giving a mortgage company a free loan for $2,500 every single month. Well, the bills aren't due till the end of the year. So if they've got $2,500 of my money from January all the way through December, they're effectively taking my money, putting it into the S&P or into the market, trying to make 10% off of it, and then whenever the bills are due at the end of the year, they just pay my bills in full. Doing what I do for a living, I prefer to keep my taxes and insurance out, save that $2,500, pay myself every month, go put my own money in the market, make money on my money, and therefore I control the narrative and I'm the one making money on my money, not the mortgage company. I suggest the same thing for folks that have money, like to manage money, and are good with it, because again, unless it's mandated, which I'll talk about here at the end, I suggest you take the escrows and the taxes and the insurance out of the payment. Now, part two of this is it affects your closing cost. So if you have taxes and insurance and an escrow account set up with your lender, what happens is the mortgage and we'll have property taxes, homeowners insurance, and the PITI all together. But when you go to close, this is where it gets tricky. Lenders will set up a prepaid escrow account. So this is just a fancy word for a slush fund. And I'm going to show you what this is because it does increase or decrease the closing costs based on your decision. So if you exclude it, if you exclude the escrow account from the transaction, not only will you not have the property taxes and the homeowner's insurance and the payment, but your closing costs will go down because you won't have an escrow account that's required. If you include them or they're mandated, what happens, you get to the closing cost part of the transaction, and every lender has to collect an escrow account. Again, it's a prepaid slush fund that is held at closing for adjustments later in the year. So let's talk about that. So every lender wants to collect 3 months of property taxes, 3 months of homeowner's insurance. So for instance, if your property taxes are $500 a month, they're going to collect 3 months. So that would be an extra $1,500 in closing cost. If your homeowner's insurance was $300 a month, they would collect 3 months of that, which would be $900. So collectively, the $1,500 in taxes and that $900 in homeowner's insurance would cost you as the consumer an extra $2,400 in closing cost, and obviously cash to the table, unless of course the seller is paying for the cost. But anyhow, the takeaway on this is if your escrow account is included in the payment and you must set up a prepaid escrow account with your lender, it's going to either save you money on the closing cost or it's going to cost you extra money on the closing cost. So people say, well, Brian, what is this escrow account for? Why do they have 3 months of taxes? Why do they have 3 months of insurance? I'm glad you asked. Normally what happens every single year as properties are reassessed, historically homes go up in value, normally probably 4 to 5% depending on where you live. Sometimes they go backwards, but most of the time, 80% of the time, they appreciate, which is good news for the homeowner. That means you're making money and your wealth creation is starting. But with higher priced homes and higher values over a period of time, property taxes also go up. So if you buy a house at $500,000 and when you close on it, the property taxes are, let's just say, $8,000. If that house is worth $525,000 next year, those property taxes are probably going to increase from $8,000 to maybe $8,300. If your homeowner's insurance to replace a $500 house is $2,000 a year, and next year it's worth $525,000, instead of it being $2,000 a year for the cost, it might jump from $2,000 to $2,200. So what happens, and the purpose of this escrow account is every year as the home goes up and the property taxes slightly increase and the homeowner's insurance slightly increases, your property taxes and homeowner's insurance will increase with it. And so the reason that they collect this little slush fund on the side is because every year as the taxes and the insurance increase, they don't want to have to chase around the consumer and say, hey, Mr. Jones or hey, Mrs. Jones, congratulations, your property value has gone up, but there's a shortage now. Your taxes were this and they're now that. Your insurance was this and now it's that. And I need $400 from you to make up the difference in what the property taxes were and what they are, and $200 to make up the difference of what the homeowner's insurance was and what it is now. So instead of doing that, because there's not enough human being power to chase everyone down and the adjustments every year, they have the escrow account, aka the slush fund. So if they had $2,400 from the time that you closed by collecting those 3 months of taxes, 3 months of insurance, and you owed them $700 because there was a shortage, they would just take from that $2,400, make up the difference, and you'd move on to the next year. And then the next year, the same thing would happen. And then they would take from the shortage, move on to the next year. Now, at some point in time, this shortage is going to get drained. When it gets drained, your lender will send you an email, something in the mail that will say, hey, Mr. or Mrs. Jones, just a heads up. Your escrow account is being depleted and it's below the reserves required. We have to adjust this one way or the other. We can either have you contribute back to this slush fund again and get it back up to where it was in the beginning to protect you, because we've used it all over the last few years to make up the difference. Or since we got to make up the difference on these future payments, because it's through 2028 and your house has gone up, if you don't want to feed this and fund this and get it back up, we'll just take it and we will adjust your mortgage payments up to whatever the shortage is, so that way there are no shortages when we request taxes and insurance and everything at the end of the year. So that's the way it works. Sometimes this escrow account runs out a little faster than normal. I would say normally it lasts about 3 years, but when you get in a market like COVID, or you get in a market where, you know, property values are just appreciating quickly, sometimes houses close and they're worth 500 and next year they're worth 570. And so that account that they think was gonna last 3 or 4 years gets drained. It'll only last a year. That's a pro and a con. The pro is you're making money like crazy on the house. The con is the taxes and the insurance are going up quick, so your obviously mortgage company is going to ask you for additional reserves after the fact to make up the shortage. So there's a lot in that to say. Again, it's either pay now or pay later. Now, last but not least, there are certain loan programs that mandate that taxes and insurance have to be in the payment. So which ones are those? Those are any FHA loans. You cannot take the taxes and insurance out. They are mandated for life. Conventional loans with less than 10% down, it is mandated that taxes and insurance have to be in the total equation and the escrow account set up for life. The ones that allow for it are conventional loans with more than 10% down. VA loans, a lot of people don't know this. VA loans, even though they're 100% financing, you can remove the taxes and the insurance from the equation. And then of course, jumbo loans. Jumbo loans are case-by-case basis. They are what's called investor specific. When I say investor specific, think of jumbo investors like fast food. There's McDonald's, there's In-N-Out Burger, there's Jack in the Box, and there's no universal rule with any of them, just like there's no universal rule with any restaurant. But I will tell you, most jumbo investors, if you put at least 10% down, will let you waive your taxes and insurance and remove the escrow account. So again, if it were me, I always recommend, if you can remove the escrow account and just pay the mortgage only, that's the way to go. You manage your own money, you control the narrative, you can pay the bills at the end of the year. The smart way to do it is whatever the amount would be that you would pay the bank. $2,000 for the property taxes a month, $500 for the homeowners insurance a month. I would just set up an auto draft like I do for $2,500 and put it into a money management account every single month. So that way, at the end of the year, when those bills were due, I had my money over here and I was ready to go. So there's no big surprises. And number two, if you put it into a money management account and you're making 4, 5, 6% of that account, you are making money on your money. Versus just saying, well, I'll pay the bills at the end of the year. Some people don't save, and then the bills come due, and this is really where you get yourself in a tough situation to where big bills are due. You have not been saving responsibly, and now that can cause a problem where if you don't pay the bills by a certain time, the mortgage company has to pay them. They will put them back in your payment. It will cause a payment spike, and it can cause huge issues for the consumer. So there are options on an escrow account. It is important that if you take them out of the equation, you are good with money, you know why you're doing it, and you're fully prepared for the future. But if you can make money on your own money, if you can control the narrative, and if you can save yourself some closing costs by removing the escrow account from the mortgage payments and the mortgage closing cost equation, I highly recommend it. So listen, if you found this video useful, do me a favor, like, comment, subscribe. If you or anybody else that you know could benefit from this video, do me a favor, share it with them. And if you want to have a conversation with me or the team about any and all things real estate, pre-approvals, where the housing market is headed, setting yourself up for success, or just having simple conversations around your financials, do me a favor, call us, text us, email us. We're always here for you. Until next time, stay tuned.